started the year thinking about oil in a fair value range between $90 and $110 a barrel. I think the situation that we have in the Middle East, in particular the disruption in Syria and the supply disruption that we have elsewhere in Libya, does support oil at the top end of that range. So we think it is likely that we see Brent between $110 and $120 now, as long as this disruption continues. I think it's actually quite rational. On the one hand, Syria does have the main focus. In fact, Syria is a relatively small oil producer. Before the civil war started, Syria produced around 300, 400,000 barrels a day. That is down close to zero. There is concern, however, that should any disruptions spill into Saudi or into Iran, then that could escalate the issues for oil supply. But as I mentioned a moment ago, we actually have to look at tangible disruption elsewhere in North Africa, and the fact that Libya is down 1 million barrels, I think makes this oil price quite rational. We do see the BRIC economies as an important driver of energy prices, and in particular the oil price. If anything, we think over the next few years we're likely to see an emerging market demand shock to the upside. We think that if we took China as the example, we think that as China moves from its investment phase of growth through to its consumption phase of growth, in fact that is quite positive for energy. It may create headwinds for other commodities such as copper, aluminium, steel, but we think for agriculture and energy it is a positive. And in a nutshell, this is the adoption of mass transportation by emerging market countries, which we think will be quite positive for oil demand to the end of the decade. I think you've got to be quite clear about what you mean by a high oil price. We pay quite close attention to the global oil bill as a percentage of GDP. Today at around $115, the world is paying about 5% of GDP for its oil. If you look back at the historic range over the last 40 years, the range has been around 2 to 8%. 5% feels to us reasonably comfortable. It does suggest, however, that if the oil price spiked for any reason to around $150 today, that would be too much. That would be well over 6% of GDP, and we think that would be today unsustainable. Well, in the UK, fracking and the associated shale oil and shale gas industry is very much in its infancy, and correspondingly any investment opportunity in the UK is fairly few and far between. I think an obvious example of a company that one could invest in today would be iGas, which is a quoted UK company with a market cap of around £200 million, which has shale oil and gas acreage in the northwest, northeast and south of the country. The investable opportunities really though exist at the moment in the US, both through investing in the exploration and production companies that own the acreage that is subject to fracking, and owning the energy service companies that are carrying out the fracking activity itself. I think if we step back and think about energy investing and how energy equities have performed versus the broad market in recent years, in fact, since early 2011, energy equities have underperformed. It's been a period of underperformance of around 2.5 years. In fact, one of the longest period of underperformances over the last 15 years. We think that has created an opportunity. We think energy equities are cheap. We think if we look at their valuations generally, they reflect an oil price of more like $80 a barrel rather than the $100 plus that we're talking about today. So we think there is good opportunity simply owning large cap oil stocks with good long reserve lives of oil. We think that oil will trade at a premium, particularly given what we see in the Middle East if that continues. So there is an opportunity. We also think there's an opportunity to own service companies, companies associated with that production. We have a focus at the moment on offshore service production, the shift in production to places like deepwater Brazil, deepwater Gulf of Mexico and West Africa, and the companies that are helping those E&P companies extract that oil, and we think that's a secular growth trend that will continue for a number of years. For my first example of cheap large cap oil companies, I would include ConocoPhillips in that group. I would include Hess, both focusing more on the conventional oil side. I'd also throw in the Canadian company Suncor, which has a focus on oil sands and we think has particularly attractive characteristics at the moment. On the oil service side, I would highlight a company called Helix Energy, which provides well intervention services to offshore production. I'd also highlight one of the largest service companies, Halliburton, which we think has very good prospects both onshore and offshore over the next few years. The fund is performing well this year. We are ahead of our benchmark, and we're also excited to say that we have a new addition to our energy team. We have Jonathan Waghorn starting this month. Jonathan is well known by the energy investment community. He's been involved in the industry for 17 years and will be working alongside me and Tim Guinness as a portfolio manager of the fund, and we're very excited to have Jonathan joining.